Today we're going to discuss where we're at as a country and if we're going into recession or already in one. And if so, why that could be good for mortgage rates and real estate. I know a lot of you get anxious when you hear the word recession, but it's a very organic part of the economy. You have expansion and then you have contraction. But let's take a look at recession in the context of our own personal households. I don't know about you, but I've been in recession for about a year now. My whole industry has. I talk to many of you. I know many of you are doing quite well. And I know some of you are also starting to feel that pinch. My point is, we shouldn't need a postcard, an announcement, or the government to tell us when it's time to pull back. And that's good because we often don't even know we're in a recession until it's already over. And that's because recessions are officially declared by the National Bureau of Economic Research. And they look at things kind of through a rear view mirror. So how are you doing? That's what matters most. Whether it's ourselves or the economy as a whole, personal savings, credit card debt, the strength of the job market, those are some key indicators of a recession looming. Let's start by taking a look at where are we as a country with personal savings. Now, this chart shows the U.S. personal savings rates going all the way back to 2000. Now, the green line is the 10-year savings rate, and the black line, that's the 10-year average. As you see going all the way back, they generally move pretty close to each other right up until the pandemic. You see these three bumps right here? Those were the three stimulus checks that were sent. It kind of artificially inflated the savings rate. It seems people started thinking they just had this extra money. Well, until they didn't. You see this precipitous drop right here, starting right after the stimulus check stopped, and look at where we are today, effectively at the lowest levels of anywhere on this chart and off by a really good margin from the 10-year average. So we're after stimulus, people are tapping into their savings, and people are living on credit cards. Let's take a look at credit card debt. You'll see credit card debt got pretty high prior to both previous recessions in 2008 and 2020. And right here in 2023, we are now at record credit card debt, right under $1 trillion. Once again, you see this incredibly sharp churn upwards from when stimulus stopped and savings started going down. People seem to be keeping the lifestyle, but they're using credit cards and savings to maintain it. But as long as people have jobs, they can make the minimum payments. And the job sector has generally been a bright part of our economy. Up until recently, there are some signs of contraction, not just from one industry and not from small companies, but companies like Amazon, Google, Disney, Dell, Microsoft, IBM, FedEx, Hasbro, crypto, Boeing, Ford, 3M, Meta. Look, these are just a handful of giant companies that are laying off workforce by the thousands over the last several months. Tech, media, financial, services, manufacturing. Never a good sign when you have significant layoffs beginning to spread like this so broadly over the job market. So we have historically low personal savings, historically high credit card debt, and a job market enduring mass layoffs. Now, these can all be signs of a recession, but there's one variable in the financial markets that's historically been the most predictable sign of a recession, and it's called an inverted yield curve. Okay, so yield curve inversion occurs when you have longer maturities that are supposed to have a higher rate of interest start to yield a lower rate of interest than their shorter term counterparts. When that happens, it's a sign that investors expect greater economic risk in the near term, so they want to be compensated. It's basically a way of the market saying they think a recession's coming, and it's historically been a near perfect indicator of recession. So this chart shows the last 5 yield curve inversions between the 10-year and the 3-month Treasury. Now, the equation of inverted yield is super simple. You just take the 10-year Treasury, which today is about 3.6%, and you subtract the 3-month Treasury, which is currently trading about 4.8%. So this number, which should yield a positive number in normal times, is currently at negative 1.2%. And the curve is inverted when you're getting a negative number. When that happens, which is 0 on this line. You look all the way back here, almost negative, recession, negative, recession, negative again, recession, negative, recession, negative, recession, and we are very negative here. In fact, we're off this chart that I graphed. So if history's any indicator, we are either in or about to head in to a recession. And remember, mortgage rates generally decline during recessions. Take a look at this chart. You'll remember from the first video on the truth about mortgage rates, we discussed how mortgages can improve during times of economic turmoil because mortgages are bonds, and the bond market tends to thrive in recessionary climates as investors are looking for a safe place to park their money. And again, it's not a guarantee, but this chart here shows that mortgage rates fell during the last 6 recessions, and in several cases pretty dramatically. In our second video, we talked about how rates come down with inflation. And I showed you when we think inflation's coming down soon. So recession could actually be another variable that supports lower rates for mortgages. Either way, we can put to rest the false narrative that is out there that mortgage rates go up during recession. Just not how it works. But how about real estate? Well, if you look here, you'll see real estate actually did quite well during 4 of our last 6 recessions. And in that 5th recession, the loss was pretty flat. Of course, we have the 2008 recession, but that was unique as it was caused by problems with mortgages and real estate itself. There were adjustable rate loans going bad. There was limited documentation loans, appraisers inflating home values, unregulated secondary markets at the head of it all. We had excess home inventory along with escalating foreclosures. It was a perfect recipe for disaster. And when lending came to a halt, this all led to a collapse. But since that meltdown, a lot of new regulations came into play. There's now record equity in homes, and the mortgages that secure those homes, they're mainly fixed interest rates, under 4%. The crisis of bad mortgages, high foreclosures, excess inventory, well, none of that is happening right now. And again, even if some of that did pick up a little bit with a recession, which it could, well, quite frankly, our market could use the inventory. As this slide shows, back in 2007, there was 4 million homes in inventory and millions less people that actually needed a home than today. Right now, there's under 1 million homes in inventory, and many of those of which are already under contract. There's just not enough supply, and there's too much pent-up demand. And that's the ultimate guiding dynamic in real estate. And I want to remind you, this is inventory at a time where rates are pretty high, and you have a lot of people on the sidelines waiting for the opportunity because a lot of them just can't afford it right now. So are we in recession? Well, there's certainly plenty of signs. But like we showed you, we have reason to believe that real estate may fare very well during this next recession or the one that we're already in. In our next video, we're going to go deeper. We're going to better understand current home inventory and really why it's so low. We're also going to better understand this housing moderation and why, in most of the country, prices are still going up. We're going to debunk this idea about a housing crash because that's not where we're at. I don't know if we're in a recession or not, but I do know we don't need a bureau to tell us what's really important. Wherever you are in life, embrace where you're at, manage your own life accordingly. I believe everybody deserves the truth. I hope you enjoyed this. If you found value in it, share it with somebody you love. As always, thank you for your time. I hope this made a difference.